Hi there, and welcome to the Stock Club podcast. This week, we're not coming to you from the top floor of MyWallSt HQ in Dublin, as we're all at home self-isolating. I'm James, and with me this week is Emmett Savage, our co-founder and chief investor, and Rory Carron, our head analyst. Well, guys, how's the self-isolation going?
Yeah, it's kind of a bit boring. It's just, I have a feeling 2020 is going to be defined by boredom, because the things that you used to take pleasure from are now either stripped away or available to you in your home where you're isolated all day. So you just basically, it's just going to get very boring.
So just for people listening, why don't you, Emma, you start off, tell us where you are at the moment and what your setup is. So
right now, this very moment, I'm in a spare bedroom in my home in South Dublin. Usually I'm in my dedicated office at home, but as it happens, my wife is also self-isolating and she needs to use the office. So I'm at home in a bedroom at a desk.
Rory, how are you getting on?
Yeah, I'm in my own apartment. I live alone, so I don't have that problem. Thank God. I don't know how I would manage working with my significant other, like, in the same building all the time. I don't think that relationship is very long.
I saw there was an article about, I think in China already there's been like dozens of divorces from people working at home together with their significant other. It's definitely it's a good test for the strength of our relationship. So let's get straight into it, and I suppose let's address the big elephant in the room at the moment. So thanks to the coronavirus that has us all sitting at home in our offices, our kitchens, our spare bedrooms, the market over the last 2 weeks has been a roller coaster, to say the least. If roller coasters tend to just go down, thanks in no small part to the spread of coronavirus. And the 11-year bull market that started at the end of the financial crisis back in 2008, 2009 has finally come to an end. At the moment, the Dow Jones has fallen more than 26% since the start of the year, while the S&P 500 is down over 22% and the Nasdaq is down close to 20%. Look, there's no point, I think, guys, in going over all the ins and outs of it. I think everyone's been kind of glued to it over the past 2 weeks. But I suppose the first thing I want to ask, and Emma, I might come to you first, is, as an investor sitting here watching the market crash like this, what do you do?
Yeah, so there's a couple of things. The first is you don't panic. And I think that's the most important thing, because it was Morgan Housel who said very recently that optimism and pessimism is always exaggerated, and you don't really know in which direction until it's past tense. So right now, the world has gone into pessimism, which is off the back of the fact that we don't absolutely know when coronavirus will end and how it will end and when we'll see a vaccine and all the other news that we're all absorbing. So it's very natural to feel a sense of worry or panic, which shouldn't be there. It's easy to say that, but once you and yours are okay, and once you've isolated yourself and once you're doing all you can to protect yourself, don't worry, because this will pass. Second thing is, I guess, we're looking at the market in, I don't want to use the word free fall, but yesterday it was close to free fall, and we've seen the circuit breaker kick in several times, which means the stock market stopped trading to allow everybody cool down. And again, this is very difficult to use your rational mind for, because irrational behavior is sponsoring that fall. And then the third thing is that for each individual business, well, everything more or less has gone on sale, but I think you have to look at businesses with three considerations. The first is, does it have enough cash to survive? Will 2 or 3 or 4 quarters of changed earnings ruin the business's story? And the third, I guess, is, will there be a recession, and can this business make it through to the other end of a recession? So there's kind of three, there's micro and macroeconomics, I guess, in that. But for each individual business, we're trying to assess, is it going to hurt for 2 or 3 quarters? Is the bigger market going into a downturn? And can this business survive and start to grow again?
So, Emmett, you mentioned there that, one way of looking at this is that a lot of kind of stocks and companies have gone on sale or gone to a discount. Is now the right time to start buying these, or do you think maybe it's still a little bit too volatile and we should hold out for a bit longer?
Yeah, it's difficult to answer that question because now implies in the moment, it implies today. And what I feel is soon we will find, I think, a bottom. But I don't know how soon is.
Yeah.
I say now-ish, like there are wonderful businesses now that have been crushed. Like they're 50+% down no time at all. They are the same business that they were 4 weeks ago. And all of a sudden you can buy double the amount of shares as you could have previously. So basically, is now the right time? Soon is the right time, but I don't believe there's a rush. I think we have to wait to see a little bit of calm come back in before we start piling in.
I suppose you could make the argument that you only know it was the right time to buy when it's already gone by, kind of in retrospect, as you've already said. Rory, I'm going to come to you. So we added a new stock to the MyWallSt shortlist this week. And when you and I were talking about it, you said that it's actually, with all that's going on, it's actually very hard to pick individual companies to kind of analyze and assess at the moment.
Yeah, I mean, just going back to what Emma was saying there, the stock market's down, what did you say, 22% so far this year? The good news is we're 22% closer to the bottom. That's all you can say about it. And this is going to be a weird podcast because usually we do talk mostly about individual companies and we don't talk about the overall market as much. But it's very difficult to consider individual companies right now. 130 companies in the S&P 500 are down more than 40% just this year. 63 are down more than 50%, and 16 are down over 70%. So
that's incredible.
Aren't those incredible numbers? And this is only March.
It's been a long 2020 already.
And, you do see wild swings in individual companies, and some of them you can kind of understand. Travel stocks are obviously going to be hit very hard. Bill Ackman of Pershing Square was on CNBC yesterday, had a little bit of a on-air meltdown and said that Hilton was going to zero. That's because the whole travel industry is going to be affected by this quite a lot. Then on the flip side of that, you have what's being called the stay-at-home stocks. So your Zooms, which is what we're using right now to record this podcast, your DocuSigns, all these stocks that help people to work from home, stay out of the office, are actually going up.
Yeah.
So, you can't, talking about individual companies right now seems almost redundant. You can talk about sectors and you can talk about spaces, but, even trying to pick, we decided, we were like, will we try and will we look at stocks at the moment in a sense of we're trying to pick up ones that have gone cheap? Will we target individual sectors, or will we kind of do what we always do, which is look at them purely as good businesses and long-term investments and just continue to do that and try and ride this out? I think that's the second one is probably the way to go for investors. The companies that you loved 3 months ago are still great companies. They're just at a much lower price than they were beforehand.
Yeah, absolutely. Emma, earlier you said when you were looking at companies, it was important to assess how much cash they have, and I suppose how robust they are. And you mentioned, if a recession comes after a downturn like this, in your mind, is a recession an inevitability?
No, I wouldn't like to call it inevitable, James. I do think it's looking increasingly likely. Countries around the world are using their cash reserves, their rainy day fund right now. Ireland, a tiny country of between, about 4.5 million people living in Ireland. I think last week, 140,000 people working in the service industry in Dublin were laid off. So restaurateurs, chefs, hairdressers, barbers, they basically were sent home. And that, in a tiny context, in the context of Dublin, 140,000 people are now joining what we call over here the live register. They need state assistance to pay the bills. And if you take that single story or anecdote and multiply it across the entire world, I think it's we're going the long tail of this event is going to be very long. And I just can't see the world not going into some form of a recession. So I hope I hope it's a short-lived recession. I think a recession is defined as 6 months of successive contraction of an economy. The average recession lasts about 22 months. I don't like to bet on the negative, but I would not be surprised to see a recession as a result of this.
Yeah, I'll give you some stats here. I think this was from a Goldman Sachs report. It says event-driven bear markets typically lead to between a 20 and a 25% decline, and the average recovery is 15 months. Okay, so that's just historically how things look. Doesn't mean it's going to happen this time, but that's the historic way of looking at it. This is the moment is the 13 worst bear markets since the late 1920s.
Wow.
But the good news from that is returns from these crashes are usually very good. So if you look back at the most recent one, 2007, the total drawdown was around 56%. And over the next year, the stock market gained 53%. And over the next 5 years, it gained 181%. So this is, you say like, we always talk about looking for opportunities. It's very easy to find opportunities in hindsight. If you were to go back and ask someone, looking back at 2007, 2008, it looks like an incredible opportunity for investors. But most investors you talk to who were, were around at that time will tell you it certainly didn't seem like an opportunity. There was mass panic. People thought America as a country was out of business, that it was that the world was being pulled apart at the seams. So, I suppose when you're in something, it's so hard to see the positives. And that's probably where we are right now. I wrote a piece yesterday about looking back at opportunities and trying to find opportunities when you're in the moment of them. And one of my favorite kind of anecdotes or kind of thoughts is the film Forrest Gump came out in 1994. And there's a great scene in that film where he opens up a letter and his war buddy had invested some money in a fruit company for him. And it turned out that company had become big and now he was a multimillionaire. And of course, the fruit company was Apple. Now, that was back in 1994. Can you imagine how many people were watching that film and thinking, God, we really missed the boat on that company, didn't we? And back then, Apple stock was sitting at around a split adjusted $1.20. Yesterday it was at $245. So, it's very simple for people to go, oh yeah, there was so much opportunity back then. But when you're in it, it's people who are able to see it at the time, who act on it, that do the best out of these things. And this is probably one of those times, this will at one day we will look back on this as a massive investment opportunity. We just don't know when that day is.
Absolutely.
Couldn't agree more.
Just to finish up then, Emmett, I don't want to call you the oldest person here, but I suppose the person with the most experience.
It's actually correct. Don't worry, James.
So how does this downturn compare with others you've experienced? So you've been investing for over 2 decades. So you invested through the dot-com crash, through the 2008 financial crisis. So, how does this current market compare to those?
Well, according to the volatility index, which is, I suppose, a measure with numbers, a measure of fact, this is one of the worst. But for me, maybe it's the fact that I'm a little older. I don't want to say I'm wiser, but I'm definitely more experienced. It doesn't feel as bad. And that could be a consequence of the speed of onset. So literally 4 or 5 weeks ago, the stock market and the world was happily plodding on, optimistically enjoying life. And next thing, we're all here working from home around the world. And the speed of onset of this downturn almost hasn't afforded us all, or me personally, enough time to contemplate in the way that I did during the dot-com bubble burst and also in 2008. So for me, it just feels like I'm almost thankful that this onset has come so fast. We didn't prepare. I mean, the 4 of us here, I include Luke, we very regularly talk about, how we will behave when a downturn kicks in. And we are behaving in that way, but it's happened so quickly. It just is. Suddenly, everything just came tumbling down. Everybody. Yeah. I did a webinar yesterday, and I could detect a real sense of trepidation, I suppose, from the attendees, but I could also equally sense excitement. I think most rational people realize that Disney is not half the company it was 5 weeks ago, but its share price is almost halved from that.
Yeah.
And I think that people now who can afford to grab some spare cash, and not everyone can, will be looking to deploy it. So for me, to your question, James, I'm feeling cautiously excited about this. And the only, I suppose, concern I have is the duration. To your question earlier, will this be a recession? And, recessions are ugly business to pull out of and sit and wait. But frankly, we four, and I hope the vast majority of our listeners, have temperament and time to sit through it and just wait for all boats to rise again.
Absolutely. So let's move on then. So I just want to mention that there's loads of great stuff to check out in MyWallSt at the moment. There's March's Stock of the Month report. There's March's Stock of the Month podcast, which is an exclusive subscriber-only podcast that lives in the MyWallSt platform. There's also our brand new stock edition, which I've already mentioned, that we added on Monday. So make sure to go into MyWallSt and check all of that out right now. Rory, I'm going to come to you now for the company we never talked about. And this is actually, I suppose, strictly speaking, a collection of companies we might never talk about.
Yeah, so I mean, it's not really a company at all, is it? We're talking about the S&P 500, which you can invest in very easily. It's the 500 largest companies in the United States as measured by market cap, and it's one of the most popular ways to invest. It's essentially an index fund. So buying one, we have an ETF in the app called VU, which is the Vanguard S&P 500 index. And what you do when you invest now is you basically invest in a bucket of 500 companies with a single purchase. And as we've been talking about, there's just different ways that the market is measured. Oftentimes on the news is reported as the Dow. They talk about the Dow numbers falling a certain amount, which is very annoying to people who work in the investment community, because first of all, the Dow is a very strange index. The Dow is 30 companies. And not only is it only 30 companies, but they weight the Dow by the actual nominal price of the stocks in the Dow, meaning that a company that has a $500 stock is weighed a lot more than a company that has a $10 stock, regardless of what the market caps of the companies are. That's really that's a very odd and strange behavior. And also they talk about it in terms of points. So you'll often hear about the Dow falling 1,000 points these days. The Dow falling 1,000 points doesn't seem to mean anything anymore. It's that's more than the Dow was worth in its entirety when it was started. So what we like to do, what investors typically like to talk about, is the S&P 500, because it's, first of all, it's a much broader collection of companies, and also that it's weighted by market cap. And we like to talk about it in percentages. So that's just a much better way of discussing how the market's going on. Talking about the S&P at the moment, Howard Marks is one of the greatest investors. If you ever want to read the thoughts of one of the greatest investors of all time, you've got people like Warren Buffett and Peter Lynch. Probably someone we don't talk about much is a guy called Howard Marks, who's the CEO of Oak Tree Capital, one of the biggest money managers in the world. And they did some research into the S&P 500 and said stocks on average return somewhere between 9 and 10% a year. However, they very rarely return between 8 and 12% in an actual given year. So really, the average is not the norm. Yeah. And why is that the case? It's because emotions get involved. It should just go up 10% a year if that's how fast companies grow, but that's not how it works. People become, things go up way too fast and then they fall up really fast. That's just the way the markets go. So investing in the S&P 500 is a way that historically will not guarantee you, nothing's guaranteed in the stock market, but historically over the long run will provide you a 10% per year return, which, if you were to put that into real money terms, means that about every 7 years, you're going to double your money. Okay. That's incredibly powerful for investors to be able to say that for doing very little. You don't need to do any research really. You don't need to follow the stock market in any way. you can really set it and forget it. And every 7 years, your money is going to double on average.
Just when you were saying that, Rory, my mind was instantly brought to like the return from a savings account, a regular savings account you might have with a bank, and for probably the same amount of effort as, you know, investing in the S&P or leaving your money in a savings account, the returns are massive, or the expected returns.
Yeah, of course. And like having money in a savings account is going to lose you money usually, because inflation is going to be worth more than the money that you are getting, the, you know, less than 1% these days that you're going to get from a savings account. Now, saying that, the reason you would have money in a savings account rather than in the S&P 500 is because you don't want money in the stock market that you're going to need in the next, you know, 3 to 5 years. That's very important for new investors to remember. Invested money is not available. It feels like it's available to you at all the time because stocks are very liquid and you can buy and sell pretty much every day of the week. You can, you know, every day of the week. But it's when you see things like what's happening at the moment, when you see massive drawdowns, that's when you realize that money should not be in the stock market. If you needed money for a wedding or you were going to buy a house in the next couple of months, if you had all that money in the stock market, you're in a bad position right now. That's, you know, that's why you have money in the same scale. So yes, comparing the returns on them is enlightening, but you also need to remember that they have two very different functions. Okay. Invested money is for 10 years down the line. That's what you're looking for. And you know, like a great quote from Warren Buffett was, you know, bad news is an investor's best friend. Because it lets you buy a slice of the future at markdown prices. And if you think the future is going to be bright, and I think, you know, you should, history has shown that it is, then this is a great time to invest in a broad market fund that will most likely, based on all the history, be higher than it is today in 10 years.
Yeah. So as we were talking about earlier, it's quite hard to pick individual companies at the moment, but perhaps the best route for an investor, maybe who's dollar cost averaging or something like that, might be to look at, you know, an ETF like VU, which tracks S&P.
Yeah, like so many times. I mean, like I'm one of the few people I know in this country anyway who is involved in investing. Pretty much the other 3 are on this call. And in the offices, you know, not many Irish people do invest in individual stocks. But I do get an awful lot of people come to me and ask me, you know, at the very start, oh, can you give me some help getting set up? And, you know, what stock should I start investing in? And, you know, usually I just tell them to download our app because it's all there anyway. But what I often find is, you know, it's that even that's just too much effort for them. And they can't, you know, they want to get invested and they want to have their money working for them, but they don't particularly have the inclination or the time to go researching individual stocks. You know, they don't even think about companies in that way. It's just not how their brain is hardwired. And it is a perfectly reasonable option for people to say, do you know what? I'm not interested in reading 10Ks. I'm not interested in learning about individual companies. You can still invest. That's not an excuse not to be invested. Investing in the S&P 500 is a really, really great way to start investing. It's a great way if that's all you want to do. You can invest nearly fully in the S&P 500 if you want, and that can be your investment strategy. Or it's a great way to get instant diversification as part of a more broad portfolio. So you can own, you know, a couple of high growth companies that you like. You might like Shopify, or there might be a couple of smaller companies that you've used yourself and you want to invest in. And then rather than building out a full portfolio of 12 companies or 20 companies, you can invest a significant portion of your portfolio in the S&P 500 and get pretty good diversification that way.
Absolutely. Okay, so that was Rory's very quick pitch for 500 companies all at once. So the S&P 500. Let's move on then to Jargon Busters. So we've got 2 questions in today. The first question is kind of an amalgamation of a lot of different queries we got in over the last 2 weeks, and it's about circuit breakers. Emmett, you've mentioned them already, so I'm going to come to you. What are circuit breakers in the market, and how do they work?
So a circuit breaker was designed as something that's triggered to halt trading, and is basically there to stop a market going into free fall. So investors are selling so fast that potential buyers can't keep up. So they're constantly revising their bids while prices continue to plunge. So a circuit breaker is a 15-minute pause during trading to allow some time out. So it allows the world to cool down, take a breath, and reassess their strategy. And we've seen the circuit break several times in the last couple of days. I actually lost count. I think it's 3 or 4 times. And every morning we get a report from our brokerage partners as to what levels we're going to see the circuit break at, and we get a further alert. It appears saying, yeah, it broke. So the procedure was actually designed by the New York Stock Exchange to, I guess, encourage patience and for everyone to just stop for a moment and back out of, you know, an emotional lock that they might be in. And it's actually worked quite well, and I was pleased to see it happen over the last few days. But you see, what's quite interesting about watching the circuit breaker in action is that it's intended to get everyone to calm, but it seems the last few days it's caused panic.
So the mere news of the circuit breaking triggers panic in itself.
Yes. Now we haven't seen, I don't think we've seen 2 breaks in the last few days. Have we? Haven't seen it break twice? No. So there's a secondary level. So the first break is 15 minutes and it's, I think it's when it drops, the S&P drops by 13%. I'm not entirely sure. The second pause is when the S&P drops by 13%. So it has
the first one is 7%.
Yeah, the first is 7, exactly. And then I think the second's at 13. So when there's repeated drops, the circuit breaks and we're all meant to just calm down and relax. And I think there's enough data now for us to actually decide, does it actually work or not? But yeah, I think it's a good thing.
Yeah. That's helpful. Thanks very much. Rory, I'm going to come to you with the second question. So Jeff, one of our longtime listeners here, asked for our thoughts on Twitter at the moment. So there's been a lot going on at Twitter recently. Most probably notably, the activist investor fund Elliott Management has bought a significant stake in the company, and kind of there's been pressure put on CEO Jack Dorsey. It looked for a while like he might have been getting the boot, but I think he's safe for now. What are your thoughts on kind of what's going on Twitter at the minute?
Twitter, oh god.
I think you said it all there.
You know, it's so hard to talk about Twitter because as a product, I absolutely adore Twitter. It is the first thing I check in the morning, usually the last thing I check at night. I use it. It's the tool I use most, even in my working day, because you can set up channels and you can follow people who you want to hear from, and you're able to digest a huge amount of news, or at least a huge amount of headlines in a very short period of time, and you're able to pick out, you can cherry pick the ones that you want to read about, and that's a great way about learning what's going on in the market in a very quick way. Unfortunately, as a stock, it has just been a real disaster. As a business, it's never really. It's weird. I found over the last 10 years, Twitter has become far more important in so many ways. And yet there's a real mismatch between its importance and its ubiquitousness in the world and how the business functions. I think a long time ago, it was, for years, it was kind of compared to Facebook because they were the kind of 2 big social media sites. If you want to, I don't know if you can call Twitter a social media site, but they were the 2 kind of big first social media companies. And Zuckerberg was often compared to Dorsey, and for an awful lot of a long time, Twitter was judged solely on the amount of users it had, and every report would be a focus on if they're growing the users. Are they catching up with Facebook's 1 billion or 2 billion users that Facebook has? And after a while, the market kind of realized that was just never going to happen. And so the focus did shift to, can they monetize the users they have? And in some ways, they have done that quite well. I mean, they crossed the $1 billion revenue mark in a quarter, just their last quarter. But it's been way too slow. And even on the kind of the product development side, it's almost been kind of anemic. The product has changed very little over the last 5-10 years. And, even when it changes a little bit, it becomes kind of huge news. Remember when they upped the character count a couple of years ago? That was a massive story for the day and the week that followed. But if you look back over the performance, it's very hard to justify it as being a good investment, because it has really vastly underperformed its two kind of rivals in the digital ad space, Google and Facebook, and even really underperformed the S&P 500 in general. And there's a lot of people pointing fingers at why that is. Jack Dorsey, as we know, splits his time as CEO between that and Square. Up until a few weeks ago, Square was doing incredibly well. It's dropped very far since then. So there's been a lot of questions asked of whether Dorsey is the right man to be leading the company. I'm quite a fan of Jack Dorsey, even though I do like to give him a bit of stick, as everyone does, for some of his this is the way he talks, the way he kind of operates. But even there was chat of him going in and living in Africa for 6 months this year. That doesn't make the shareholders don't want to see that when they're, over the last 5 years, the stock has basically been cut in half.
Yeah.
So yeah, my thoughts on Twitter are that I really hope that it becomes a good investment, but I do think that we need to see some big changes in the company. And that when you mentioned that Elliott Management intervention, they also got like $1 billion invested in them from Silver Lake, and Dorsey seemed to at least sat down with them, and hopefully we will see some changes going forward. But yeah, not a stock I would invest in unless we start seeing something change in the next kind of couple of months, because they really haven't given us much to hope for.
Absolutely. I think we're all three of us here are avid Twitter users, and it's kind of a shame to, we always say invest or buy what you believe in, and it's kind of a shame that the performance of the company doesn't match the importance of the product. So that was your thoughts on Twitter. So let's finish up then with the elevator pitch today. So we're going a bit left of field with this elevator pitch. With all the craziness going on in the market at the minute, it can be quite overwhelming to be an investor. So what I've asked you guys to do is to pitch me your best method for staying calm during a crisis. I usually give you 30 seconds to do this, but I can't really put a time limit on it because it might just induce more panic on you. So Rory, I'll let you go first. What's your best method for staying calm during a crisis?
Yeah, so funnily enough, it was probably about maybe it was last week last week. It was one day in particular I found like quite overwhelming. I don't know if it was that there was an awful lot of kind of news coming all at once, but I was trying to write the Daily Insight, and I think I started about 5 of them and then couldn't finish them because my head was just kind of all over the place. And yeah, it did have that kind of sense of, God, this is just really overwhelming. And because of the way we work, not only are we dealing with our own personal lives, but you have to read the news. The news is part of your job, so it's and it's part of your work, and it's part of what we do. So a couple of things I've done was, one, I have deleted or muted all the notifications on my phone that send those breaking news updates.
Yeah,
because that just wasn't helping matters at all, especially when you have 10 different news apps on your phone and they're all sending you essentially the same thing. So that's been good. And now I check the news kind of once or twice a day just to see what's going on. And the other thing is I've started using an app called Headspace, which is a kind of meditation app. And I wouldn't have ever been very big into meditating or anything like that, but this is I find it very helpful. It just kind of guides you through sitting kind of quietly for 5 minutes and breathing, and you feel kind of refreshed when you come out of it. So those two things have definitely helped me kind of keep a cool head over the last couple of days.
I think you're sounding a lot more zen anyway. Emmett, how do you keep calm during a crisis?
Well, I fully agree with Rory. Now, maybe it was Rory who tipped me off to mute all my news apps, but I did that. And I similarly to Rory, just have decided I'm doing one binge on news a day, and I'm not. I just don't want this constant stream distracting me. I found that to be in its own right kind of distressing. So switching off the constant flow of news, definitely agree. I suppose from an original standpoint, when I look at the market, when I look at my portfolio, I have always looked at the numbers, the money invested in my own family's portfolio and the Horizon portfolio. I treat it as if it's not my own money. I actually act as if I'm an advisor to myself, which sounds like I'm hacking my own thought process. But in doing so, and if you are a parent or a guardian, or you're managing money of somebody younger in your life, I think that you actually force yourself into that mindset. You actually you're the grown-up. You are actually treating their money in a professional, I suppose, mindset. So I suppose my own mind hack is I always look at the money that I have invested as if it's somebody else's, because it allows me to be a little cooler and more dispassionate. So I guess switching off news and trying not to allow it sway a long-term strategy that you've committed to, because it has been proven to work. And I guess making sure that the money you've invested, you don't panic. We've put it away for the long term, and treating yourself like your own fund manager per se.
Yeah, that's very
helpful. I also think as well, it's so easy to get tied up in all the negative news, but there is positive news out there as well. You look at what's happened out in South Korea and in China, they are flattening the curve, as is the term that's being used. And even I saw an interview with the Swatch CEO who said that they're opening all their stores back up in China. They expect things to go back to normal in a couple of months. So, there is positive news out there. You can't always focus on the negative. And that's a big part of kind of keeping a cool head in times like this.
Absolutely. And just to add to that, I think you can also get a sense with this kind of global crisis that there's very much a sense of the world kind of banding together for this. So kind of those typical kind of animosity that exists between countries, I think that's really kind of starting to dissipate with this. So hopefully it continues. And that's about it from this week's Stock Club. Don't forget about all the great new stuff in the MyWallSt platform at the moment. And if there's anything you want us to discuss or explain on next week's episode, please make sure to get in touch with us. You can catch us on Twitter, that's at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club. And if you're enjoying the podcast, please leave a review for us on whatever podcasting platform you listen to us on. That's it from us here today. We'll talk to you in 2 weeks. Happy investing, and please wash your hands.